Hi there, and welcome back to another episode of Red Spark's Crypto Blog for your Cardano and crypto related news. This episode is going to mostly focus on the traditional financial markets and how it relates back to the crypto world. But before we do that, let's have a quick look at the crypto markets. Looks like Bitcoin has taken a dip in the last 24 hours and it's bringing down the rest of the market with it. Binance Coin, not so much. Solana, not so much, but Cardano certainly has been hit quite hard there with a negative 5.2%. Still above the $2 mark, which is all I can ask for at the moment until we get working dApps. Polkadot, not too bad. It does have its parachain launch, I think, in the next week or two. Dogecoin and Shiba Inu, so the two meme coins, they're not doing too well. Although it looks like Dogecoin has pulled a little lead ahead of Shiba Inu for those that care about that. And whilst we're on that topic, Solana has now got a bit of space between it and Cardano. But the way I look at it is both BNB and Solana show you how valued coins are when they have working dApps. As these two coins are not decentralized, so that's certainly not what's causing their value. So when you've got a coin like Cardano, which is decentralized, has a lot going for it, and really the only thing that it's missing is working dApps. And even then, it's already at a market cap of 64 billion. Just imagine how high this can reach once it does have working dApps. Further down the list, it looks like the rest of the alts have also been hit. Axie Infinity, they're doing rather well. Let's take a quick look at my new acquisition, COTI. So in the last day or so, that's been hovering at these levels, and I've been sort of steadily purchasing it at these levels. So this is a good buy, in my opinion. There was a US stablecoin report by Gary Gensler to Congress. That's definitely worth reading. And it was also covered in Army of Spies video this morning, so I do recommend watching that. COTI, I feel, is in a good position. It follows all of the regulatory rules that are out there. It has KYC, and it's also separated itself from the US market as they wish to enter once there is that regulatory clarity, which is what this report gives them. And here's a copy of the report in case you're looking for it. It's actually authored by the President's Working Group on Financial Markets, of which Gary Gensler is a participant. Every once in a while, I like to dip my head back into the traditional markets just to see what they're up to and get ideas for what might happen in the crypto markets. So I logged on to CNBC.com, and this article here, traders move up expectations for the Fed's first rate hike to the summer of 2022. What this is talking about, well, there's two things. First of all, the Federal Reserve yesterday announced that they would start winding down its bond program. So the bond buying program is the mechanism by which the Federal Reserve has been using to inject liquidity, US dollars, into the system. So they've been buying back the treasury bonds, T-bonds, which is effectively US debt, and in exchange they've been releasing US dollars out into the wild, into the system. And so as a result, we've had this high inflation, and house prices have gone up, and crypto prices have gone up, and things like that. So now that they're starting to wind it down, there'll be less money sloshing around out there. And traders are also now betting that the Federal Reserve will start to raise interest rates as well, possibly as early as July 2022. So what that means is for the last, I think, decade or so, we've had historically low interest rates. That has made it cheaper for companies to get loans and do business. But the Federal Reserve will now start raising interest rates in a bid to try and cool down the overinflating economy. From a crypto perspective, my view is provided these things are done gently, as so as not to spook investors and spook the market, then hopefully it shouldn't impact crypto too much. The worst case scenario would be that the raise in interest rates suddenly leads to a whole bunch of home buyers defaulting on their mortgages, or companies struggling to pay back loans. And then that has other repercussions on the economy, and it leads to panic in the markets. And the Federal Reserve will be well aware of this, hence why they try and signal their intentions early to try and give people a heads up. So, something to keep an eye on. From a crypto trading point of view, it might mean that there's less money around to be spent on some of the riskier assets. So, it might mean the price of some of the riskier altcoins may go down over time, and you may want to consider exiting those positions. And now is probably a good time to say that I'm not a financial advisor, and nothing that I say is financial advice. Also, if you're enjoying the video, please be sure to give it a thumbs up. And thank you to my 16 viewers from yesterday and 56 viewers from the day before, not to mention those who provided a thumbs up or have provided feedback in the comments section. This channel to me is more of a hobby, but getting those responses and knowing that people out there are actually watching this channel gives me motivation to continue developing it. So thank you very much. Okay, the next article to catch my attention was Welcome to the Metaverse, 3 stocks that could pay off from its development. And this is off the back of Facebook's rebranding to Meta, which is their new name. And that's based on the idea that things like virtual reality, remote working, and that sort of stuff will be far more prevalent in the future. I think there's a recognition that we have now fundamentally shifted away from the in-person meetings, in-person business, to a much more remote virtual society. And as a result, companies like Facebook as well as Microsoft, for anybody who's been listening into their Ignite conference this week, have recognized the need for virtual reality and augmented reality solutions. What this could mean from a crypto point of view is NFT coins such as Engine, where you could transport assets from one metaverse to the other, could potentially be important in the future. Again, it's not financial advice, but that's the sort of thoughts that come into my head when I read articles like this. Next up, in one of the most volatile markets in decades, active fund managers underperformed again. So if you think about the crypto market, there's 2 types of people, the traders who buy and sell and try and beat the market. And then there's the hodlers who, like myself, who simply buy a couple of coins and hold on to it and hope that the price will rise. In the traditional markets, you have similar things. You have active fund managers and passive fund managers. And this research shows that active fund managers have underperformed yet again. As it says, if there ever was a year active management should have outperformed passive index strategies, 2020 and the first half of 2021 should have been it, but that didn't pan out. Of the nearly 3,000 active funds Morningstar analyzed, only 47% survived and outperformed their average passive counterpart in the 12 months through June 2021. So roughly half beat and half lagged. It was what you would expect from a coin flip. And that really just goes back to decades and decades of history showing that active trading strategies don't often beat more passive income strategies. Over a 10-year period, only 25% of all active funds beat their passive counterparts. And then when looking at how stock pickers can be so wrong, there's a nice quote here. A blindfolded monkey throwing darts at a newspaper's financial pages could select a portfolio that will do just as well as one carefully selected by experts. And that was from a book written in 1973, and not much has changed since. Why can't active managers outperform? First, active trading involved market timing, and the evidence is that market timing is very difficult to achieve, as we all know from the crypto markets. When you are trying to time the markets, you have to be right twice, going in and going out. Even if an active manager managed to outperform, high fees and trading commissions eat into whatever excess performance alpha they are able to generate. That made me think of Ethereum and the very high gas fees on that blockchain. Finally, performance is getting worse because active fund managers are competing mostly against professionals. And that's where I was thinking about as the crypto market matures, more and more professionals and big whales are getting into it. And with crypto markets, there's much less regulation. So it is somewhat akin to the stock market prior to 1929, prior to the Wall Street crash, when there's a lot more manipulation going on. So a lot of good takeaways there that can be applied to the crypto markets as well. And the very last bit of traditional financial market news is that Zillow is abandoning its home flippening program. So, for those who don't know, Zillow is a website that displays houses that you can buy. So, estate agents would pay a fee to advertise on their site. But in the last year or two, Zillow decided to make use of all the data they've been collecting to build algorithms that could try and forecast a good bargain when they saw it, and then buy that property themselves, then turn it around and sell it to somebody else. From a consumer perspective, it meant you could find a buyer straight away. You didn't have the pitfalls of trying to secure a buyer and then it all falls apart at the last minute. But from Zillow's point of view, it turns out the algorithms were badly miscalculating the sales price of a home. And in particular, it looks like what happened was as soon as the real estate market started to dip slightly, the Zillow algorithms went into panic mode and started selling the houses at a loss to what they actually bought it for. Why am I mentioning this? Well, this was one of the riskier stocks I used to be invested in prior to entering the crypto market. So when people say that cryptocurrencies are highly volatile and risky, just goes to show that in some ways the traditional markets can be riskier. At least with the volatility that I see in the crypto markets, one day it's down 7%, next day it's up 7%. And provided you are cautious about what you're doing, I feel you can make money. And in the long run, I do feel like crypto is on the up. Whereas something like Zillow, which sounded like a great idea on paper as somebody who comes from a data analytics background, once this has lost value, it's going to take many, many years for this to ever come back up. But again, this is definitely not financial advice. The crypto markets could easily go down for the next 4 years, and we'll all be in hodl mode waiting for them to go back up. So that's it from me. If you like this video, please give it a thumbs up, provide feedback below, or hit subscribe, or follow me along on Twitter. And you can see there a picture of Mr. Kevin O'Leary, who famously was a crypto cynic until as near as a year ago, with a nice quote: "The best developers in the world are in the Bitcoin community," which is quite a funny quote given that Bitcoin famously doesn't have any smart contract capabilities. But on that note, I hope you all have a great day.